Hi, everybody. My name is Nikki Piscavages, and I wanted to talk to you today about the differences between saving with simple interest rate accounts, compound interest rate accounts, and an annuity interest rate account. So first, let me break them all up. So simple interest, that means it's based on the principal amount of a loan or a deposit. So the principal is the amount that you are borrowing. And this method is the easiest one to calculate. Compound interest is the principal amount, the amount borrowed, or the amount being put in, and interest accumulated during every period. And then an annuity interest rate account grows each year and is determined by insurance companies. So pretty much you're just taking out a contract with the insurance company. And it's all dependent upon how much money you invest, what the interest rate is, and how long the contract length is. So I think I'm going to go over, let's do the annuity interest rate account. So an annuity contract has two stages. The first stage is the accumulation stage, which is when you're saving up your money and you're growing your funds. Then the next stage is called the distribution stage. Another word for that is annuitization, which is converting your funds into retirement payments. So there are four types of annuities. There's an immediate fixed, immediate variable, a deferred fixed, and a deferred variable. So when you're dealing with the variable, it is more risky because you're putting your money into the market. Okay, so all of these different types of annuities are based on two factors: when you'll receive your payments and how you want it to grow. So when, let's say you pay the insurer a lump sum, like a large amount of money, and that's considered immediate. Or you could do future monthly payments, which is called deferred. That way, yeah. And then through growth, you can have either the fixed, which is through an interest rate, or the variable, which is market investments. So for the immediate fixed, the good things about that is you get your money right away and you don't have to monitor it because you're not betting on the market. And you know what your final amount is going to be. The bad thing about it is if you die, no one gets that money, no one gets paid, and then you're pretty much trading liquidity. The immediate variable, the good thing about the immediate variable is it has death benefits. So if you were to pass away suddenly, those benefits would go to your family. And also you get benefits from the market when the market's doing good, and it's guaranteed, and it's a lifetime income. The bad things about it is that's it, the market, because you don't know if the market's going to go up. You have no idea if the market's going to go down. So you could end up losing your principal, which is the initial amount that you put in. And for deferred fixed annuity, that is the easiest one to understand, and it has principal protection. And there's no control limits and no market impact. The only thing that sucks about it is there's an early withdrawal penalty if you take your money out before the time that you put in. Then there's the deferred variable. Remember what we said with deferred, meaning put off to a later date, and variable, which means putting your money into the market. So pro-tax deferred growth during accumulation market benefits. The cons of it: early withdrawal penalties and market fluctuation, of course. So the thing to remember about an annuity is investing in a variable annuity involves risk. You can lose your principal. So keep that in mind when you're thinking about what to invest in. The next one I want to go over is called compound interest. All right. The cool thing about compound interest is it's not the same over the life of the loan. So compound interest is good for investors, but bad for things like mortgages and auto loans and stuff like that. So there's actually a formula to figure out the compound interest. All right, so this is the final amount. This is the initial balance, which is called your principal. And 1 plus that is your interest rate over that's the payments and the amount of payments annually. So let's say like 12. So amount of payments annually times time, which would be the years. And that is how you're able to find out your compound interest rate. So the cool thing about compound interest is based on the principal, which is the initial amount, interest is calculated based on that. So interest can be compounded daily or annually, which is pretty cool. So let me give you some examples of something kind of interesting. Simple interest. So let's say you take out you put away $100,000 with 5% simple annual interest. So for that amount of time, you do 10 years. In 10 years, you'll have 50,000 extra. With an annual compound annuity, let's say 5%, you put down 10,000. In 10 years, it'd be about $63,000. It's harder to understand, but the rewards are higher than the rewards for simple interest. And then there's compounding interest, which is actually the most interesting to me. It's good for investments, but it's bad for credit cards and purchases. And now I'm going to talk about simple interest, which is probably the easiest to understand, but it doesn't give you as much payback as the other two would. So simple interest is calculated with this formula. All right. All right, so here, this is going to be your final amount. And this is your initial payment or your principal. You're going to keep hearing that word. And then you do 1 plus the interest rate and the time in years. So this gives you the answer for your simple interest rate. Simple interest is used mainly for car loans and some mortgages, but there's also a part of simple interest that's a little complicated. It's an amortization schedule. So lenders come up with a schedule of when your payments are due. They include the different amounts. For one of those amounts, it'll have the interest payment, and then the other one, it'll have the amount you're borrowing. So as you keep paying, your interest payment is going to go down over time. So that means you're paying more into what you're borrowing instead of just your interest payment. So you never late on the interest payment charges. So it's kind of interesting how they keep that log or whatever. Car loans use it. It's some mortgages. So to find your simple interest, you do your principal, the initial amount, times your daily interest rate, and then you multiply it by the number of days between payments, like how long you take to pay your bill. The cool thing about simple interest is it's good for you if you always pay your bills on time. Also, it's good for you if you pay them early, because the earlier you pay them from the date, I believe it's less money compared to when you pay it the day of or the day before. So you would be saving some money if you paid your bills early. So I think simple interest, I think that's good for the car loans. I don't know about mortgages though. I think so, yeah. Simple interest is probably good for mortgages also. Honestly, compound interest, it's a very interesting concept. I like the fact that it's not the same over the life of the loan. So compound interest is really good for investments, but really bad for credit card payments, auto payments, mortgages. And then there's so many options with the annuity interest rate account. So I suggest getting one of those when you're younger and start investing in it monthly, because if you do that, the amount that it's worth is going to increase over time. Like I said, there's 4 different types: the immediate fixed, the immediate variable, deferred fixed, and the deferred variable annuities. So you just have to pick which one is going to benefit you now or in the long run or whatever your situation is. For me, I don't know, I'd probably get a deferred. I think I'd get a deferred variable. I'm already invested in cryptocurrency and have some money on some stocks. So in my future videos, I will go more into that. So I hope this video helps some of you out and you understand a little bit better what these different interest rates mean and these accounts and which one is going to help you in the future. So like I said, I would seriously suggest the annuity interest rate account for the future for your long-term retirement investments. I suggest the compound interest accounts for your investment funds. You could do it in shorter periods too, like 5 to 10 years, instead of taking it out for so long. And for the simple interest, I suggest that for mortgage payments and auto payments. Thank you.